Hello, everyone. This is Andrew Berman. I'm coming to you for the Mortgage Leadership Outlook. We are doing something special here. This is something you've probably never seen this before because we started this before we could do this. So Mortgage Leadership Outlook started because of the pandemic. We wanted to meet with some great leaders and say, actually, got to have an idea of what's going on. But we now have an opportunity to meet face to face, masks off, and it's great. And none other than, Robbie Chrisman to join us actually as our first guest. I think it's awesome. Robbie actually happened to be here staying in Manhattan. So Robbie, thank you so much for joining us.
Thanks for having me. Good to be here.
So hopefully you're listening to the Chrisman Commentary podcast. It is the daily podcast. There's the offshoot of the Rob Chrisman daily newsletter. It's like the Bible to mortgage banking. And it's something actually that I'm so glad actually you guys do it in a podcast because I'm just too lazy to read. I'm just gonna be call it like it is. I'm lazy to read, and listening actually to the daily podcast. It's great because Chrisman's put out great content. But before we get started here, there's a couple of things I want to talk. We want to talk about margin compression. I want to ask you a little bit about some things about maybe about SoFi. I want to understand that. I want to also talk about what lenders can do to kind of win with technology today. But so this just boggles my mind. You're a young guy. How old are you? About
29.
29. No social media, right? Nothing, right?
Yeah, for all intents and purposes. Yeah, it's using my dad's LinkedIn and having used Facebook in years, and no Instagram, no YouTube. Normally I have a face for radio, and that's why we podcast. I don't come in front of the camera like this. So this is new for me.
That's good. It's like my mom's always told me that I have a face for radio. But now it's the face for podcasting. That's the new thing. Let's and now you do actually use, I guess, LinkedIn a little bit to kind of put the podcast out there. So what was it like growing up actually in the mortgage business? So you've been exposed to the mortgage business from early years. Did you have a love for the mortgage business?
I think it's just something you fall into. I had a joke growing up that when kids would ask me what my dad did, I would say he works at an exotic nightclub as the bartender because I was too embarrassed to say he was a mortgage banker. And so, of course, after that, the way life would have it, I end up in mortgage banking. But no, it's a great industry. There's a lot of really good people. And at the end of the day, it's about helping put borrowers in homes and helping them save money every month on their housing expense. And so it's not all bad news. I enjoy it.
So did you kind of go into it I'm going to find something else. I'm going to do something else. Yes, I've got, because you grew up around mortgage companies, you had great knowledge. Were you saying, okay, I'm going to do something else just because it's just too easy to kind of do something in the mortgage business because of the experience, because of the contacts? Did you say actually that you wanted to go a different path?
Well, when I graduated 5th grade, my dad said, "You're old enough to start working." And I started digging ditches at for a summer job for construction companies and working with a bunch of people that helped me hone in on my Spanish. But after a couple of years of that, I said maybe a desk job would be a little more enjoyable. And so I started doing internships in high school. I worked for what's now Lend Us. It was RPM at the time. I worked for Bay Equity, worked for People's National Bank out of Colorado, and majored in finance in college. And it just was a natural progression for me to do this. And it's tough feeling like I'm riding my dad's coattails sometimes because of his name, but I have a background in it and I enjoy doing it, and it's been good to me.
Yeah, being actually you started pretty early. I'm pretty sure actually that it's almost going to be like your dad's going to ride your coattails pretty soon. I think so. But so interesting. So all right. So you've been involved with a lot of mortgage companies. You've seen in today's world. So I'm going to just kind of switch topics, talk about some of the things I wanted to talk to you about. What does lenders need to do to kind of win in today's marketplace? What do they need actually to beat the big lenders? Because most of the people that are going to be watching this are independent mortgage companies, mortgage brokers, small to mid-sized mortgage bankers. What do they need to do to kind of compete in today's marketplace?
Well, what I always like to say is, regardless of the industry you're in, whether you're making hamburgers or making mortgages, there's three things you can focus on: product, price, and service. And you can never have all three. So pick two of those. And when it comes to mortgages, know what you're good at. That's one thing. Hone in on that. And yeah, at the end of the day, like I said, it's about putting borrowers in homes. And if you sacrifice that for the sake of selfish means or whatever it might be, your referrals are going to dry up. You're going to wither on the vine. It's not going to be good. This is a referral-based business at the end of the day. And so if as a lender, if you know your products, you know your client base, and you can really cater to that, I think that's a way that you're going to be successful. And it's an incredibly cyclical industry. And if you look at some of the big players that were around in the 90s or the early 2000s, they're not around anymore. So really being able to focus on what you're good at is one way to weather the cycles as we make our way into a margin compression environment.
And we're back. Sorry about that. So I want to thank our host, AmeriFund. Thank you so much. We are in the AmeriFund headquarters right here in Manhattan. They've got some actually interesting bespoke mortgage products, actually, where they're actually designing each individual loan based on the investor that's actually going to be putting money into that loan. It's really, really interesting. AmeriFund, thank you, Alan. Appreciate it. All right, so being customer centric, I mean, that's what it seems like. It's like, being in tune with the customer. When you got in the mortgage business, it wasn't like that. It was like the industry was focused on profits and trying to be as profitable as you possibly can without actually even focusing on being customer centric.
And I think that we've seen that change now in a lot of different types of businesses, whether it's Apple or Tesla, where you're really catering towards a customer experience. As millennials start to want to buy homes and move out of their parents' houses, it's important to realize what people are looking for. And part of that is, I want to be able to upload documents on my phone. I want these different things that are going to make it easier for me, make me want to refer you to my friends. And not all that is so profitable to start. You got to put some money into the technology and building these things out. And the upfront cost at the end of the day, hopefully, is worth it. And so, yeah, the landscape has certainly changed. I mean, there'll be great years like there was last year or even into the first quarter of this year where there's record volumes and record profitability, but it's not always going to be like that.
Yeah, definitely want to talk about the profitability thing because it's something that a lot of people are scared about. I mean, they're seeing signing bonuses go out to try to keep the production up and, just doing everything we can to try to bring in the business. And of course, rates, we're doing everything we can in terms of pricing. But so going back actually, to being customer centric, like so SoFi. I mean, obviously you were there actually when they stood up their residential mortgage platform, right?
Mm-hmm.
So what was that like actually, being actually at a leader like SoFi and being actually there when they got the mortgage going?
Well, I'm sure it sounds sexier from the outside than it is on the inside, where you get close to the hull of the Titanic and you see all the cracks in it before it even hit the iceberg or something. No, it was exciting times. You're moving 1 million miles a minute, and you have this venture capital backing, and no isn't really in the vocabulary, and you're just going full speed ahead. And so we tried to build things out as best we could, and sometimes you started building really good engineering code on top of not so great scaffolding below, to put it one way. And it was great though, because all these young people that I was in my early 20s at the time, a lot of my coworkers were in our early 20s as well, or in their early 20s as well. We had a ton of responsibility and we're able to shape this and say what products are really catering to millennials. That's who we're trying to capture, these Henry borrowers, high earners that are not rich yet. How do we do that? You guys are that age. What would appeal to you? And so it was really exciting to go through that.
It's the only other person besides myself that's ever used the Henry acronym is you. So that's great. High earner, not rich yet. I love it. So, all right. So now, obviously, it's a new business model that's been generated, using technology. What are some other interesting business models that you see being, created out there, that just differs from what we're seeing right now in traditional mortgage banking?
Well, I guess there's two ways to look at it. Are you talking more about the vendor side of things? Or are you talking more about the lender side of things?
So let's focus on the lender side of things. I would also like to talk about the vendor side of things, get your perspective. But when I was thinking of that, I was thinking more of the lender side.
You know, I actually don't know if I have a great answer for you on this, because the way I look at mortgage banking, there's four main channels essentially. You have your direct to consumer, you have your retail, you have your wholesale, and your correspondent. And it's about cutting your cost down. You know, people are seeing the same prices out there when they go to sell a loan. It's what did it take for you to actually produce that loan, you know, in a compliant manner, in a way that is going to create a quality product at the same time as minimizing your cost, and whether that's finding new ways to lower your cost per click, or if you bill yourself as a rocket style lender, push button, get mortgage. And there's ways to do it that way. But I will say a lot of it, in the case of Rocket, it comes down to it's the same mortgage process.
Yeah.
And so it's really hard to differentiate yourself that way. As I said before, not to sound like a broken record, know what you're good at. And if you can really dial into what you're good at, that'll be one way to lower costs. And at the end of the day, when margins shrink and volumes start to recede a little bit, then you're going to be in a much better position than some of your peers.
There's a lot of lenders out there that aren't good. They just actually happen to be because there's old business models that are still able to exist. Can they change? Can old mortgage bankers that have done things that have always the way they've always done, what are the easy things that they could change? And maybe this is kind of a vendor thing, maybe the innovation in vendors. Like, what are things that a traditional mortgage bank that's been good, they've had nice profitability, but they know they need to change. What could they do?
I think one thing that gets overlooked a lot of the time is a lot of these lenders have great tech. They have a good tech stack. They're constantly being sold on the latest, greatest thing, but what they have is pretty good. And it's about actually training your employees to know what you have and know how that tech stack plays with itself. And I think that the tools are there for a lot of lenders to do a good job.
Yeah.
A lot of the time it's a bright, shiny object classifying. You say, oh, I need that to do well. And that's not necessarily the case. That's an interesting question about, can an old dog learn new tricks? Because when you go to these conferences in the mortgage industry, you see a bunch of 63-year-old white guys walking around in suits, and you think, where's the youth? Where's the youth? And so things that might seem more intuitive to you or to me, a lot of these mortgage companies aren't thinking of. And I really think it comes down to borrower experience. Now everything is on our phones. Everything's so easy. We want things fast. I don't want to wait for a pre-approval letter. I want it now. I want it all. And if lenders can kind of get behind that without cutting corners on compliance and without running afoul of certain regulations, because there's a lot more of those than there were in 2007, then I think that's one way that they can position themselves to be really successful.
Yeah, and maybe not celebrate a 14-day close. I mean, it's kind of silly that we're still actually celebrating when it bogs my mind that we don't actually have instant mortgage process. I mean, it's like the data's already out there. Basically, we know how much I make. We know how much I have in the bank. We know how much the house I'm buying. It's all data that exists out there. The decision criteria to make, to decide whether a bank's going to give me a loan, it's already out there. It's already made. And yet we're celebrating if we can close a loan in 14 days.
I had some friends actually go through the pandemic and were trying to refinance, and one of them told me it took him 9 months. So 14 days sounds pretty good in comparison, but I do agree with you. I think that a refi, I won't say those lenders, it was a very big national lender, but I guess there's room for improvement. And like you, I agree that that's where the industry is headed. And if lenders are looking to get ahead of the curve, then that's where you're going to be able to do it, is to reduce your cost per click and to reduce your reduce your time to originate the loan, which is going to reduce cost in its own way. And there's obviously, over the next 5-6 years, hopefully even shorter than that, we should see that really come to the advantage of borrowers, where it's faster and it costs less for them, and hopefully it benefits everybody. And the companies that are able to be on the forefront of that are the ones that are going to be the most successful, in my opinion.
Yeah, and most can survive the margin compression that we have that we're facing right now. So let's talk about what do we actually what can lenders do right now to kind of to not just survive. Surviving is not fun. Thriving in a margin compression times, because I'm looking at some lenders that have a very low cost of originations. They're not writing checks to sign on actually that originator that's cranking out 400 loans a year. What can lenders do to kind of thrive in the margin compression?
Well, I'd almost say shame on you if you weren't prepared for this. We knew it was coming, and many of you that have been through the market cycles before should know that the mortgage industry is arguably one of the most cyclical industries out there.
It's sick. It's cyclical and sick.
Yes, and not preparing for this when margins were amazing and volumes were amazing. I don't want to say you deserve to be punished, but your peers were getting ahead of the curve at that time, and so. Yeah, exactly. The best way to do it would have been to have cash on hand for a rainy day, because we knew this rainy day was coming. And what we've seen here, even this week, I wrote about this yesterday, the latest mortgage applications survey from the Mortgage Bankers Association showed that overall activity dropped despite rates dropping. So it looks like the borrowers that were eligible for refinance are refied out, kind of refi burnout is happening. And we're having to shift more towards a purchase-focused environment, even when rates are still low. And we've seen some other things that are going to hurt lenders as well. Whether that's you look at the record low inventory, supply constraints that are pushing up housing prices. Home affordability is going down for first-time buyers, and so I'd like to think the people watching this show are very smart and intelligent if they're watching this show, and they should have known that this was coming.
Don't shame our audience.
No, sorry. I hate to sound like a broken record again, but it comes down
margin compression shamed right now.
know your products well, and if you're good at what you're good at originating, then stick to that, and you should be okay, and you should be able to weather this storm, and it's going to be brighter days ahead after we go through this. Yes, there's always some reshuffling, and we've seen a lot of mergers and acquisitions over the last couple of weeks as a result of the shifting rate environment. But people are going to come out the other side, and we're all going to be better off for it.
Yeah. So I'm just going to play devil's advocate. Let's say, what happens actually if like the new norm becomes the regular norm? Like we're going through this margin compression. Everyone's trying to figure out a cut costs, and we discover new models. Like let's say better.com.
Mm-hmm.
Like something like that, where there's no commission loan officers. So could our industry just completely change? Could this margin compression be so intense because people have built up a lot of some have just used technology to address actually the growth, but a lot of them actually just added people, added actually fixed costs, and it could actually it could leave actually opportunities for people actually, or for lenders that can do it at a much lower cost and a much larger scale. Could that potentially change the landscape of our industry, permanently?
Hopefully. I think that there's obviously going to be opportunity out there for forever. People are always going to need homes. People are always going to want to be able to refinance and lower their monthly housing expense.
Yeah.
And so we talk about these technologies, and at some point they're going to become ubiquitous throughout the industry, and those that weren't early adopters, or those that were stuck in their set ways and said this worked for me a couple of market cycles ago, the world's constantly changing, and so being able to be flexible and adaptable to that, I do believe hopefully a new normal is coming, and it means less than a 14-day close, when a 14-day close is about the worst case scenario out there.
Cool, awesome. All right, listen, we're gonna wrap this up with a question I think that's on everyone's mind. Where do you guys get these jokes from? Okay, so if you read the Chrisman Commentary, or you watch it, you probably actually have caught some of the jokes. Because they're always actually it's never a bad joke. I don't get it. It's always just a little bit racy, but not too racy, and it's good. It's not not too controversial. It's something you could say it's a PG-13, sometimes almost R.
And sometimes we do get feedback from people that it's a little over the line, and if some of you feel offended by that, we do apologize. Can I reveal the secret sauce?
That's why
that's the only reason he brought me on, was to spill the details on the
aerobatics, all these other things about it. But yeah, this is really what I wanted to know. So
yeah, I will say this. I'll say two things on it. A lot of jokes have been around since the start of time. It's updating it for modern circumstances. You could tell a lot of these jokes back 80 years ago or 100 years ago. The other thing I will say is that we have great readership interaction. People will write in and say, "Hey, I think you should use this joke," and we'll say, "Thank you to so and so from South Carolina," or "Thank you to whoever," and we love getting jokes from people, and trust me, there's jokes lined up for months and months and months.
Oh, really?
That's yeah. Hopefully that tells you a little bit about how we do it. Can't tell you everything.
That's great. All right, so we've learned a lot here. We've first off, I mean, the joke thing, that's important. We learned actually, some of the things that you guys could do actually in terms of margin compression, how to use technology, I really appreciate. And again, thank you so much for AmeriFund for letting us use your headquarters right here in Manhattan. Just reach out to AmeriFund. Our good buddy over, Alan Bachman, has invited us down there. Thank you so much, Alan. We really appreciate it. Anything you want to say in closing?
Thank you very much for having me. Thank you, AmeriFund. This has been great. And I didn't mean to shame lenders that much. I just think that there's a lot of opportunity and a lot of actually easy, low-hanging fruit when it comes to improving your technology stack or finding ways to fight margin compression. And
fantastic. And of course, you can go to robchrisman.com if you're not already. I mean, I'm sure you probably are, but if you're not, you can go to robchrisman.com and the podcast, so you can catch Robbie every day around 8, 9 o'clock ish or so, whenever iTunes decides to update. You just search Daily Mortgage News podcast, and you'll get that. And of course, Mortgage Leadership Outlook is also, we also have a podcast too. Just search on whatever podcast platform you're using, Mortgage Leadership Outlook. You'll be able to find us. It's obviously on iTunes or the Apple Podcast, and that's about it. So everyone, thank you for joining us. We will see you again next Wednesday, 4 o'clock East Coast time, 1 o'clock Pacific, and stay safe.
Thank you.